All right, welcome to The Explainer. Today, we're going to pull back the curtain on how massive corporations are even possible. It all boils down to one powerful idea: share capital. This is the financial engine that literally powers our modern economy, and we're going to break down exactly how it works, step by step.
So let's start with a big question. When you see some giant global company, have you ever stopped to wonder where that first mountain of cash came from? It's definitely not from a single bank loan. The answer is actually a brilliant legal and financial structure that lets them pool money from thousands, sometimes even millions of different people.
Okay, so here's our game plan. First, we'll tackle what a company is in the eyes of the law. Then we'll decode its financial fuel. That's the share capital. After that, we'll walk through the actual process of issuing shares, see how the money gets tracked, and finally, we'll look at some common plot twists you're going to see out there in the real world. First things first, before we even get to the money, we have to understand the strange and unique entity that's raising it: the company itself. And the law has a very clever name for it: an artificial person. At its core, a company is really just a legal fiction. It's a concept that gives a business its very own identity, totally separate from the people who own it. And this is huge because it means the company itself can own property, sign contracts, and even go to court, all under its own name. And this legal separation, it gives the company some incredible superpowers. As a separate legal entity, it's its own person. This is what creates limited liability, which is key for protecting the owners. And with perpetual succession, the company can basically live forever, even as the owners come and go. And this right here, this illustrates maybe the most important feature for any investor: limited liability. Look at the left. If you're a sole trader and your business goes under, your personal stuff, your house, your car, it's all on the line. But on the right, as a company shareholder, there's this legal shield. The absolute most you can ever lose is the money you put into your shares. Your personal finances are safe. That separation is a complete game changer. Okay, so this artificial person exists. But how does it get its money? Well, that brings us to our next big topic: share capital. Think of this as the financial fuel that makes the whole corporate engine run. To put it simply, share capital is just the money a company raises by selling off tiny pieces of itself. Each little piece is called a share, and the people who buy them, they become part owners or shareholders. It's really the ultimate form of crowdfunding. Now, this whole process happens in stages. You can think of it like a funnel. Right at the very top, the widest part, you have the authorized capital. This is the absolute maximum, the legal ceiling on how much money the company is ever allowed to raise by selling shares. It's written right into its founding documents. But think about it. A company probably doesn't need all that cash on day one, so it issues just a portion of that total. This is the issued capital. It's the slice of the pie that's actually up for grabs right now. All right, so the offer is out there. Now investors see it and they decide, yep, I'm in. The total value of all the shares that investors agree to buy is the subscribed capital. It's the amount that the market has actually subscribed to. Now here's a neat trick. Companies often collect the money in installments. They'll make a call for a part of the payment. So that amount they've officially asked shareholders to send in, that's the called up capital. And finally, we get to the bottom of the funnel. And honestly, this is the number that really matters: paid up capital. This is the actual cash that has landed in the company's bank account. This is the money it can use to build factories, hire brilliant people, and grow the business. Okay, but here's the thing. Not all shares are the same. You've got two main flavors: preference and equity. Think of preference shares like VIP tickets. You get your dividend paid first, and if the company ever winds down, you get your money back first. The catch: you usually don't get a vote. Equity shares, on the other hand, are for the true owners. You get full voting rights and the potential for huge returns, but you are last in line if things go south. It's classic high risk, high reward. All right, so we've got the concepts down, but how does this actually happen? How did those shares get from the company's idea board into the hands of real investors? Let's walk through it. And believe it or not, it boils down to a pretty straightforward three-step dance. First, the company issues a prospectus, which is basically a super detailed sales pitch and an official invitation. Second, people read it and send in their applications along with some money. And finally, the company goes through the applications and officially allots or assigns the shares. But wait, there's a really important safety net built into all of this. It's called minimum subscription.
The idea is that a company can't just take a little bit of money and run. It has to raise enough capital to actually be viable and do what it promised in the prospectus. And yeah, regulators put a hard number on this. It's not a suggestion. A company has to get subscriptions for at least 90% of the shares it's offering. If it doesn't hit that mark, the whole deal is off and every single cent has to be refunded. It's an all-or-nothing game. But what about the opposite problem? What happens when an issue is a massive hit, a blockbuster, and way more people want shares than are actually available? Well, this is called oversubscription, and it happens all the time. Okay, let's switch gears and actually follow the money. And this isn't just boring accounting, I promise. It's about seeing the financial story play out as cash literally moves from an investor's wallet into the company's bank account. So, when that first wave of application money comes in, the company's books basically show two things. One, its bank balance goes up, and two, it creates this temporary holding account for all that application money. It's just a clean way to keep track of the funds before any shares are officially handed out. But this brings up a really practical question. The company has allotted the shares, it's called up the next payment, but a shareholder just doesn't pay. What happens then? Well, that situation has a name: calls in arrears. It's essentially an unpaid bill from a shareholder. The company tracks this amount, and depending on its rules, it can even charge interest on the overdue payment, often up to 10% a year, until it's paid up. All right, for our last section, let's get into a few plot twists. These are special cases that you see all the time in the real world of issuing shares. So, you've got these really strong, popular companies, right? They don't just sell shares at face value, no way. They issue them at a premium. So if a share has a face value of, say, $10, a hot company might sell it for $12. That extra $2 is the premium, and it's pure capital profit, reflecting just how much investors believe in that company. Now, here's a pro tip about where that premium money goes. The company can't just spend it on anything. It has to go into a special, restricted account called the Securities Premium Account. This money can only be used for very specific things that the law allows, like covering the costs of the share issue itself. So here's the bottom line. From the legal magic of an artificial person to the financial funnel of capital, issuing shares is this incredibly powerful and highly regulated process. So the next time you see a headline about a company's massive IPO, you'll actually know the intricate journey that money is on, from a simple application to an official allotment, and finally, into the paid-up capital that's going to fuel that company's future.